99% of what we do is property catastrophe. We do have some specialty in the portfolio, especially with things like aviation, marine, satellite launch, crop insurance, things like that. When there's a $100 billion hurricane, prices are going to go up and they're going to stay up.
I want to just come back to this rise in natural disasters, because for the outsider, there does seem this increase in both frequency and severity. Is that myth or reality?
It depends which peril you're talking about. If it's hurricanes, it's myth. The number of landfalling hurricanes in the United States is unchanged over the last 50 or 60 years. If you look at secondary perils, wildfire, clearly what happened in California earlier in the year, the drought, and rainfall for flooding, those types of perils are clearly on the rise. Quantum computing has been a huge benefit to insurance and generally climatologists. The theory behind it had been established for probably a couple of decades. So computer power has really been beneficial in trying to model the atmosphere and climate, because it's highly, billions and billions of variables. You don't want to take 2 days to do a simulation. You want it to run an hour.
Welcome to Money Maze Curated Podcasts. We created this spin-off channel to highlight a selection of innovative firms in the finance sector and beyond. As wildfires engulf residences once considered safe, floods sweep through sleeping towns, inundating their populations, and hurricanes decimate communities, these natural disasters appear to be intensifying in both frequency and ferocity. Therefore, who, you might think, wants to be in this insurance business when these risks and events appear more frequently? Yet capitalism is a powerful tool for answering problems and creating solutions, and by definition, capital flows to where it's treated best, and catastrophe insurance can be profitable and is an increasingly invested in niche which we're going to examine today. From the incumbents to the challengers, established firms like Munich and Swiss Re to hedge funds, capital is on the move, and today's guest is CEO and CIO of a highly respected asset manager sitting in the property catastrophe risk market, dealing with those sometimes apocalyptic tragedies. Hurricanes, earthquakes, tornadoes, hailstorms and brush fires, hardly your usual menu of risks. Stephen Velotti, CEO and CIO of Pillar Capital, welcome to this curated edition.
Thanks for having me.
Well, you've made a particularly torturous journey because you've come from France, you navigated the strikes.
I think hurricanes and earthquakes are easier to navigate than strikes.
And you arrive here to find there's a tube strike, and as somebody pointed out to me, the Docklands Light Railway has had no drivers operating for a decade, so the sooner we move to automated tubes, the better we will all be. A quick shout out and thanks to your colleague James Larner, who made the introduction. That's absolutely great and fantastic to have you here. So let's just talk a little bit about your history to set the stage. I read that you studied English.
Yes.
Before pivoting a decade later to Columbia University for your MBA.
Yes.
That looks like a good time to make that pivot. What did you take from those two qualifications?
I think, you see a lot of financial people who can't write a paragraph. And originally I was an English major because I wanted to go to law school. Started working at an insurance company, was going to take a year off before law school, liked what I was doing, and then never made the switch. So after 10 years, the company I was working for was kind enough to pay for my MBA while I still worked. So, when you get tuition that's 100% off, you take it, and off we went from there. So it was quite good.
So you work your way through the insurance world, and what was the trigger or the set of reasons that got you to think about Pillar?
So I started my career as an insurance underwriter, then moved into reinsurance, worked there for a number of years, moved down to Bermuda, was an initial member of a company called Ariel Re, which was a startup after post-Katrina losses. And then a banker came to me and said, hey, we're going to start a fund that's going to do natural catastrophe, but it's not going to be heavily reliant on catastrophe bonds. And we could probably talk about that a little bit later. It's going to be mostly private reinsurance. I got introduced to the CFO, Tara Railton, and off we went. And the startup happened.
And a lovely place. I used to do business with Orbis down in Bermuda, so I was an annual visitor when I was at Morgan Stanley there. Worst places to work.
That's right.
So, Pillar Capital Management today. Can you just summarize your business? What do you do and for whom do you do it?
So we do nothing different than the big companies like Munich Re and Swiss Re, but we're using investor money. So instead of having permanent capital the way those companies have, where they trade on the stock exchange, investors invest with us. It's a 1-year transaction. They can keep their money in after that to do year 2, 3, 4 if they choose. But we essentially reinsure Lloyd's and U.S. insurance companies and things like that. So it's all about natural catastrophe, hurricanes, earthquakes, brush fires, etc. Those things are disconnected from the financial markets. If you look at Katrina and the Japanese earthquake and tsunami, and you look at the S&P that month, there's been no reaction. So the main value proposition is the lack of correlation, and that's what it's all about.
And just tell me a little bit about your ownership.
So the management team owns half the firm, and Berkshire Hathaway owns the other half. Great partner to have. Berkshire is not involved in the day-to-day running. They sit in the background. They come to the board meeting once a quarter. We bounce some ideas off of them, and then they go back to Connecticut or wherever they're from, and I don't talk to them for 3 months. So the management team's in charge. We're making all the decisions day to day. We got a great partner in the background if we needed to. So yeah, great partner to have.
So hurricanes, earthquakes, tornadoes, hailstorms, and brush fires. As somebody who doesn't know this space well, I have learned in my research property catastrophe events are short-tailed, in inverted commas. So can you explain, first of all, what is meant by that? And then, secondly, what sits under the umbrella of this catastrophe risk? Yeah,
so if you just took a hurricane, clearly we all watch it on TV. It's going to be covered by the news. We're going to know we're having claims. You probably know 90% of the claims within about 3 months. It's the last kind of 5 to 10% that takes the rest of the year to kind of figure out what the exact number. There's inevitably some litigation around some of these claims and things like that. So when we talk about short tail is claims that get settled within a year, maybe 18 months. If you look at something like asbestos, it takes 30 years to figure out whether you have a claim or not. That is very, very long tail. So because we have investors in the fund for a year or two, we want to be able to settle claims quickly. So hurricanes, earthquakes, aviation, brush fires, things like that, that's all short tail type of business.
And as you refined your business, was it that duration that was attractive, or was it something else that led you to this very specific niche?
Do investors really want to do a 10-year lock fund? Probably not. So because you can't do asbestos and some of the casualty lines, the short tail stuff is property. There's a lot more research. There's a lot more modeling. We use computer simulation to come up with default rates are and things like that. So with asbestos, nobody knew that was an issue when they wrote the insurance policy. They found out 10 or 20 years later. So that's the stuff we're trying to avoid.
Got it.
Yeah.
Got it. And as I went through your materials, yeah, unlike a lot of investment firms, there you have your chief actuary, you have your chief underwriting officer. There's a whole layer of professionals that wouldn't exist in other businesses, obviously.
Correct.
But I want to just come back to this rise in natural disasters, because for the outsider, there does seem this increase in both frequency and severity. Is that myth or reality?
It depends which peril you're talking about. If it's hurricanes, it's myth. The number of landfalling hurricanes in the United States is unchanged over the last 50 or 60 years. Okay. 1 year you might have 5, and the next year you might have 0. But if you drew a trend line through the last half a century, it goes straight across the page. So from that standpoint, hurricanes are not really being impacted by climate change, despite what the mainstream media might say. If you look at secondary perils, wildfire, clearly what happened in California earlier in the year is being impacted by climate change. The drought, and rainfall for flooding, those types of perils are clearly on the rise. And then you factor in the fact that there's a lot more stuff in the way. There's a lot more houses in California than there was 50 years ago. The losses can be quite severe.
And just give us a sense, because I had friends who lived, not then, but previously in Pacific Palisades, that gets burned to the ground. If you were rebuilding, can you get insurance?
Yeah, the state of California will insure you if you can't find insurance elsewhere. So there are residual pools in almost every state that you can get insurance if you may not like what you have to pay for a price, but you can get it, because you really can't borrow money without insurance. Yep. Insurance is really the backbone of the financial industry.
So you have these climate-driven forces raising demand. So from that perspective, you have a nice tailwind for a business. On the other hand, we've got technology everywhere, and we've got satellite data. We did an interview with Seraphim Space, and some of the extraordinary stuff is how is, I'm going to use loosely AI, but satellite data technology helping you in the prediction game?
So we're really actuaries. So we're not trying to be meteorologists and predict what's going to happen over the next 3 weeks. That's for the weatherman to do. We're looking at long-term trends. So from that standpoint, quantum computing has been a huge benefit to insurance and generally climatologists, because the atmosphere and climate is highly complex. They really had a pretty good understanding and have a pretty good understanding of how it worked. It was being able to do simulations quickly that's really been the benefit. So when you get your 6-hour weather forecast that the hurricane is coming to you, that is about as good as we can do it, and that's because of quantum computing. The theory behind it had been established for probably a couple of decades. So computer power has really been beneficial in trying to model the atmosphere and climate, because it's highly, I mean, billions and billions of variables. You don't want to take 2 days to do a simulation. You want it to run an hour.
So let me ask you to join the dots. How does that help in the underwriting process there and then, or is it simply that it's helping you make longer term predictions?
A little bit of both. So clearly there were historical hurricanes. We have good hurricane data maybe for the last 100 years. Tampa Bay hasn't had a direct hit from a significant hurricane in recorded history for the United States. That doesn't mean it can't. So what the simulation and computing program does is it takes existing hurricanes that we know happened and then moves them around the coastline and creates this huge catalog of hurricanes that have never occurred. And you want to be able to run that relatively quickly, not days, to figure out what the default rate is of some of these transactions. That's really where computing and the theory behind hurricane formation has been helpful to us.
And when we read about these terms, cat bonds and ILS, just to, again, explain to those who are thinking about this space as allocators what that means and how they are, interacting with them.
Yeah, so ILS stands for insurance-linked securities. That's generally, it's like Hoover.
Right.
Everybody calls the vacuum a Hoover, even though that's the brand name of it. So it's a bit of the same thing. So ILS is private reinsurance, which is mostly what we do. Cat bonds have QSIPs and trade, so there is some liquidity to that. But we're all under the same banner of insurance-linked securities.
Okay. And who are the investors for whom this is best suited?
So it's mostly people who have a long-term horizon. Trying to time the insurance or reinsurance market is fraught with mistakes. You want to be able to look at it in over multiple years. So it's institutional investors, pension funds, endowments, large foundations, people who are not trying to come in and out. Traders are oftentimes not rewarded in reinsurance.
So I'm an allocator, or I'm a university endowment. I come to you and I go, well, I like your returns, I like your approach, your thesis, and we'll talk about some of the dimensions in a minute. I can have a 1-year contract, but am I, if I'm a long-term investor, actually wanting more than that? In which case, do I invest for a longer period, or do I have the 1 year and roll?
So we do offer a multi-year lockup. From that standpoint, we'll give a little bit of discount on fees, but in general, most people leave their profits in and roll to next year and next year. It's your option, but most people don't take that option. They're in it for the long run.
And if we talk about customer stickiness, what's the percentage of customers that roll?
It's relatively low. Who roll is relatively high. We generally have the same investor base from year to year. It's not people in and out.
Okay. Which I guess brings us to the question of competition. There was an article in the FT you probably saw the other day about the whole, universe and capital that's being deployed. Just give us a sense for, other than the big names, where is the capital coming from and how competitive is it?
So alternative capital, which is what ILS is probably about 20% of the market. So 80% is still the Munich Re's, the Swiss Re's, the permanent capital type of vehicles. They've been growing. There's been retained earnings over the last couple of years. So in general, capital in the space has been increasing. But between inflation and COVID and building more things, there's more risk in the world. So as long as those things grow relatively at the same pace, pricing and margins should stay relatively expanded across the industry.
So back to that analogy, I'm an endowment manager, I'm coming in, I'm getting to understand the space. I clearly understand that there is a very low correlation, if no correlation, to classic economic cycles. How should I think about the cone of returns?
So it's clearly a fat tail distribution. Lots of years there aren't going to be significant events and you're going to collect your coupon. And then some years there are going to be a couple big events and you're going to have no returns or maybe eat into investor capital. But it's predominantly positive returns with a drawdown. Some years you might make a 20 and some years you might make a -3 across the industry. It's all randomness.
And if I was being advised by you, but you weren't in the title that you have, and my question was, how long should I commit capital to this space for? What do you think is the sensible time period?
We ask investors to look at it at a 5-year increment. It's still a 1-year lock, and you can leave if you decide or change your mind or have some issue that you need your money back. But of those 5 years, 4 will probably be pretty good, and 1 might not be so good. And that's the randomness of natural catastrophes.
And we referred to your actuarial team and your underwriting team, but how has the world of modeling risk evolved?
Before 1990, models didn't exist. It was all done by feel and historical losses, which in the 70s and 80s, there weren't a huge amount of historical losses. It was generally a quieter period. So computer modeling, there's vendor-based models, which there's really 2 main ones which people purchase. That does a lot of the simulations that we may not have the resources to do that. But oftentimes those models are not up to speed. They're either old or they haven't been updated in 5 years. That's where the manager has to come in and provide their own adjustments. So we have our own in-house modeling team that will enhance the existing vendor-based model.
So whilst your specialty is property catastrophe, there are a lot of things in that tent, aren't there?
Yeah.
How do you think about capital allocation?
So it's all about risk reward. Florida has the best reward. It's the biggest risk. You can't put the whole fund into Florida. If there's a huge hurricane, you're going to have a huge negative that month. So it's okay to get the higher margin business. You do a little bit in Australia, you do a little bit in Europe. You kind of spread it out, come up with a risk reward that's reasonable and without really the big negative that could happen.
So in my world, that would be portfolio optimization. Is that right? You're trying to. But there is, of course, a danger you get over diversification.
That's right. We refer to it as diversification.
Diversification.
So
okay.
I'll use an example. There's a Chinese reinsurance market. There's no functioning court system. There's political risk. The data is really only 10 years old. You don't have 100 years of historical data because the government suppressed everything before then. China is going to look great in the portfolio, but that's a diversification. You're in an environment that you don't fully have an understanding of. You really need local talent. We all exist in Bermuda. It's going to look awesome, but we're going to skip that deal.
Okay. Give us a sense of the assets that you are managing, and then we can talk a little bit about your growth trajectory.
So we're a little over $4 billion of assets.
Right.
So institutional level size, we have all the, compliance officer, operations people, things that a big institutional investor would require.
And you have to manage that tension of growing because you want to grow, and underwriting discipline because that's essential to the integrity of your brand.
That's right.
So talk me a little bit about how you plot your way.
So size is somewhat important, but the ultimate size is really doesn't matter. It's your growth rate. If between inflation and new building houses and things like that, if the world is growing 5 to 10% more stuff in the world, you should be able to grow your assets 5 to 10% and maintain your exact same position. If you grow faster than that, there better be a shortage of capital for you to deploy that, or else margins are going to start to decrease.
And right now, how would you define the market?
I'd call it probably even. Margins, buyers and sellers are probably equally, they probably have equal tools. Margins are elevated across the industry. There's an ebbing and flowing of pricing, and it's generally on the high end now.
And is some of this capital, I'm not going to use the word flaky, but very transient?
Not really. I mean, our investor base has been relatively stable. Every year you have someone who leaves to go do something else, and you replace them with somebody new. I mean, we have over 100 investors.
Right.
Some are bigger than others, for sure, but in general, they tend to stick around for long periods of time.
And I wasn't so much asking that question of pillar of the industry, because capital's come out of hedge funds, which is not what you are, into that space. How enduring might it be?
I think for the most part, 17 and 18 was a bit of a rough patch for the industry. So there were some investors that left around that time. We were able to maintain most of our stable of investors, but some of the underperforming managers out there had capital flight. But in general, I would say that the big institutional investors, whether they're in the space or not, have a generally high education level. And when they do enter, they tend to stick around for a while.
And back to that return profile that the clients coming to you are thinking about. I mean, I've looked at some of the data from the Swiss Re Cat Bond Index, but indices are inherently flawed.
Yeah.
How do you? What's the conversation that you have with the CIO about expected returns?
Yeah, the expected returns long term are generally reflect at the equity market, but there's no equity risk. So, around that double digits, with a general drawdown of 10, 20, 30% in a really bad year, that's quite similar to what the reinsurance market provides.
And a question that actually came into us from somebody who is looking at this space is counterparty risk.
Yeah.
Tell me a little bit about how you evaluate that.
It's relatively minimal. They owe us the premium, and then we have to pay the claims. Generally, claims paying is much larger than the premium income. If it works no different than your motor insurance. If you don't pay your premium, you get canceled. It's the same thing here. So if we're reinsuring an insurance company and they can't make that month's or that quarter's payment, if you have a loss, we're not paying because you essentially defaulted. So it's pretty straightforward. There's minimal credit risk.
So you don't need to rely on the ratings agencies, or what I'm getting at here is that in the chain of risks, the evaluation of your counterpart, where does that take place? Some
of the smaller companies, we will do a financial valuation. They're private. They'll send us the financials. I mean, if you talk about Travelers or Co-op or AIG, there's plenty of people analyzing the financial situation of those companies. As long as they maintain the rating that they have, we don't waste our time doing that. We know they can pay their premium.
And when you have an investor partner like Berkshire Hathaway, who are obviously known for their insurance expertise, what is it that you offer them, that allowed this partnership to develop and going in an ongoing basis? What sort of dialogue do you have with the group with so much experience?
So the ongoing dialogue is more strategic. We don't really share, what do you think of this deal or that deal? Those conversations don't really occur. So Berkshire Hathaway inherited our ownership from Trans Re. So Trans Re is really a casualty-based reinsurer that operates in the States. So, but from that standpoint, Berkshire's been nothing but supportive. And insurance-linked securities is here to stay. It's not going anywhere. Berkshire is not involved in it. So this is their foray into that space.
And we haven't really obviously alluded to the fact that some of these natural disasters are occurring across the US, but it's a big playing field of disasters.
Yes.
Just give us a sense of the geographical equation.
So as far as risk?
Yes.
US, Europe, Japan, Australia, New Zealand, there'll be different times where you increase and decrease different parts depending on what the margins are that you can get in those areas. When you're starting getting into the other countries, again, you have data issues, you have political issues, you have functioning court system issues and things like that, like I mentioned earlier. So, there's areas that, what do you need? You need risk, and you need natural disaster, and you need wealth, and you need them to be in the same place. And then there's a robust insurance and reinsurance market. So if you look at something like Switzerland, robust wealth, not a lot of natural disasters. If you look at the Philippines, disasters all the time, relatively poor, insurance penetration is low. That's not really a market either. So you need both. And where do you have both? You have it on the coastline in the United States, California earthquake and wildfire, European windstorm, Japan windstorm and earthquake, and the same thing in Australia. So that's going to be the preponderance of risk. There is risk in Mexico and Canada and those types of places, but generally it's much lower than other areas, or insurance penetration is low, and the values of things are just not enough to get to the reinsurance world.
And we live generally in a highly regulated financial sort of set of industries. How do the regulations interact with you?
So in insurance, it's highly regulated. In the U.S., there are 50 regulators. Each state has its own regulator. There's no, aside from the National Flood Program, which is federally funded and backed, all the wind pools and earthquake pools, they all refer to each state. So you got 50 regulators, and then on top of that, you have the rating agencies, AM Best and S&P and Moody's that look at these insurance companies. So it's a highly regulated part of the financial services, and the reason for that is they want to make sure that the customer or the person gets paid. They don't want insurance companies taking too much risk, and then when the disaster happens, they end up insolvent and the claims aren't paid. So the amount of leverage that insurance companies have is certainly limited by the regulators.
Let's talk a little bit about your team. As I said, as I read your materials, I got a sense of it. But just tell me how you're organised, key players, and where you might be other than Bermuda in the future.
Yeah. So generally, it's a very flat organization. If you ever come to the office, there's no offices. We all sit on one big open floor. When deals are out and about, we want to talk about them as a group. Everybody has different experience levels. Some underwriters or PMs we have were heavy international at their former company. Some are heavy U.S. Well, let's pool all that information. Like, I'm the boss. I don't know everything about every insurance company that ever existed. That's just preposterous. Let's use the team's experience when it comes time to deploy capital or do a deal. Hey, do you know something about this company that maybe isn't in the material that they send? So there's a sharing of information across the group, and that's very, very important. We're also historically insurance people. There's no bankers, there's no traders on the team. The team is all insurance. So there's no top line growth issues. We're more than happy to say, hey, this deal doesn't work. We got a couple of dollars undeployed, and we'll find a place for it next time.
And I know you just come from the reinsurance conference in Monaco, and I'm clearly understanding that was a big sacrifice to have to go to Monaco for a couple of days for that. How is the mood amongst your community?
I think the mood, again, is pretty. Buyers and sellers are kind of at a standoff. I think in general, margins have expanded across the industry over the last kind of 4 or 5 years. That's generally remained high. And, in talking, I did a few interviews with reporters and things like that. And most of what they got was that most of the markets really aren't keen to start giving any of that back. So I think we're going to stick around in above average return area for the next 12 to 18 months. And what happens after that, we'll cross that bridge when we come to it.
And are you tempted to broaden your remit?
So 99% of what we do is property catastrophe. We do have some specialty in the portfolio, especially with things like aviation, marine, satellite launch, crop insurance, things like that. We have expertise for that. Generally, the margins have been weaker than property cat. So right now, it's about 1% of the deployment. We can increase that if some of those subsections look pretty good, but they're generally small. And when margins expand in those subsections, it's very fleeting. If there's a big plane crash, putting the human side to it, prices spike up, and the next year they go back down again. When there's a $100 billion hurricane, prices are going to go up and they're going to stay up. It's not going to come right back down again. So generally, we'll move capital from one area to the other. We're a relative value play. We don't have a target allocation for Florida, and we don't have a target allocation for Japan. If it's looking pretty good in Japan, we'll increase the deals there or increase our allocations of those deals. And if something starts to weaken, we'll start to shrink that and move capital to a different place.
Are you saying, well, what we have noted from the data is that the preponderance for this to happen in Southern Europe, for example, is noticeable, and that's being fed into our models, or is some of this simply unknowable geographically?
No, there's general trends. Again, the hurricane trend overall is straight across the page. There is really no trend to that. If you looked at wildfire, the number of wildfires across the United States is roughly the same as it was 30 years ago. The acres burned are probably double or triple what they were. So that's clearly an indication of climate change. And just talking about climate change in general, everybody, talking about drought and wildfire is easy because they go on TV, it's filmed. What about rainfall? Like in the United States, the eastern half of the U.S. has had more rainfall than it did in the earlier part of the century. The West currently has had less. So when it has less, the probability of wildfires are much higher. On the East Coast, everybody's lawn looks great, all the golf courses are green. Nobody cares about that. That doesn't produce claims. All the water in the world is essentially still here. The Earth's atmosphere is sealed. It's just all moving around in different places now. And we need to anticipate that. Clearly, we've made significant adjustments for the propensity of wildfires, and pricing has risen materially.
Right. And we see a little bit of that here in the UK as the UK wine industry is developing fast because of the advantages of a slightly, more friendly, climate.
Yes.
Strategic opportunities looking ahead. I know you've hinted about that you've got some fringe activities, but, as you clean piece of paper right now, where would you want to commit new capital outside of your core?
Certainly the specialty area is something we've been looking at. Aviation, satellite launch. And when I say satellite launch, it's all about the satellite itself. That's who buys insurance. It's generally the rocket makers are self-insured. So from that standpoint, those are areas we've been looking at. Some of it's over-regulated. The crop insurance in the United States generally is controlled by the federal government because nobody wants the farmers to be upset. That's politically poor form. So generally they tend to have a lot of subsidies for that, and crop insurance tends to be minimal margin in that area. So from that standpoint, specialty specifically here in London, Lloyd's of London is the epicenter for specialty insurance, and we've partnered with a couple people there to explore that.
When you are interviewing, what are the 2 or 3 things you want to see? And I'm not saying that it's a chief underwriting officer, or that it may be, but what are the 2 or 3 things you want to see to persuade you that person's going to be an asset?
I think from a junior person, there's certainly insurance designations and exams you can take. If I see a university grad who did some exams on their own time, okay, that person's serious about being in insurance or reinsurance because they spent their free time doing this. So from that standpoint, I think that's a benefit. We've hired a few people who made career changes. We have one analyst who's on board who is a Bermuda police officer for 10 years. He's more mature. He's got little kids. I know he's not going to go backpacking around Europe on me like some of the more younger people would do. So from that standpoint, that's quite beneficial. On the more senior side, there's very few senior people we interview that we don't know. The industry is not that big. You may not know them directly, but you know somebody who knows them. So you can do some vetting to make sure they fit in with the culture pretty easily.
So I'm quite interested in some of the materials that I'd read. I got the sense that in some ways you are an unintended beneficiary of the tariff uncertainty that has been perpetuated. So first of all, could you just comment, is that right? That is definitely right. Again, we are detached from that. Tariffs can cause inflation over the long run. So inflation will drive up claims cost. We can see that. Generally, construction inflation, so the cost to repair buildings and houses, roughly runs about 300 basis points higher than the CPI. We can factor that into our analysis. Right now, it doesn't seem that inflation is increasing, but that's something we would monitor. But from that standpoint, what tariffs do to the equity market doesn't have anything to do with us. So, Stephen, if I was summarizing, and I've got to know your business, and I've been in the capital allocation business, for all of my life, I think it would be fair to say that probably along with litigation finance, this is an uncorrelated area.
Yes.
I would say that...
And by the way, litigation finance is the exact opposite of us.
Right.
That is what we don't want. When people ask, hey, what's a good hedge for... Well, litigation finance is kind of a good hedge because that's... Who's paying that? Insurance companies are.
Yes.
So anyway,
we had a very nice interview with Balanced Legal Capital on that subject.
But
that's but nevertheless, I see that those characteristics are unusual, and there's a tendency, as I may have mentioned in this business, to talk about uncorrelated returns, which proves at times of crisis to be anything but. There is, I think, what I'm learning from you, that there are equity-like returns that are available with cyclicality, but behaving differently, and that despite some of the suggestions that this area is becoming overcapitalized, there seems to be quite a balance that's been struck, which leads you to be quite constructive about the growth rates ahead.
Correct.
My final question, I suppose, is that as you talk to the investors, and particularly those endowments and pension funds for whom you are best suited, generally, what sort of allocations do they have, if they have them at all?
Yeah, it's probably anywhere from 2 to 5%. The non-correlation benefit is a huge lure for those folks. Most people are not really more than that. Although the capital allocation models would probably say it should be 10 or 15%, but it's still an industry that's growing. People are getting more knowledgeable. When you go into a pension fund or an endowment, there's an expert in private equity and merger arbitrage and credit, and like they got somebody there. They probably don't have an insurance-linked securities expert. So the education process and the onboarding process really takes a long time. So once they do get involved, kind of mid-single digits is probably the top end of what we've seen institutional investors allocate to the space.
Yeah, and on my travels, I would say certainly through a UK European lens, much less.
Yeah,
which is, of course, the opportunity.
Yeah.
Stephen, it's been terrific to understand your business, more. I think you might be the first, guest we've had on who's, partially owned by the Berkshire Hathaway group, which is no bad thing in a world of trusted partners. And so, thank you very much for, giving us such clarity on this segment.
Yeah, and thanks for having me. This has been great.